If you know anything about markets, a market doesn't deal in reality. It deals in what people think the reality is. So you're trying to figure out how this particular news event is going to go over in the crowd, not for the end result. You see something, an oil field blows up, a big oil field, and I'm just making something up here, and all of a sudden oil is going to be scarce, so it's bullish for oil. Well, you'd say, all right, is the crowd going to pay attention to that? And that's the issue. What does the market focus on, and when does it decide to focus on it? Because if you're out of step with that, you go broke waiting. They're not looking at something that you consider very important, then you're out of luck. You better get in step and find out what they're thinking. And those are the most important words for me when I was in a trading.
Hey everybody, welcome back to Markets and Madness. As you know, this is the place where we discuss the madness that occurs when economics, politics, and personalities all move in different directions. Tim is here with me today. And first of all, I want to thank everybody who's commented. We really appreciate it. For everybody that subscribed, we really appreciate it. If you think what we say is interesting, please tell your friends, help us grow this. We've just started out a couple of months ago, and we're starting to see some real growth, and we're very happy about it. And we're very happy because it seems like people are interested. So that's what we're trying to build on. What I'd like to do today is talk a little bit about where we're coming from, what we look at, and what our background has been. I've been in the foreign exchange markets since 1979. I do a lot of seminars, and I start by telling people that I was in a trading room when Jimmy Carter was president. And most of the young kids have no idea who Jimmy Carter was. So we go back, and Tim has been further along than me. But I'll let you introduce where you've been, and then we can discuss our history.
Okay, well, I started in a small British bank called Schroders back in,
J.
I
Henry
guess I went
Schroeder.
to work there sometime in '9. And it was an interesting time to be there because the world financial system, which had been running since the end of World War II, blew up kind of while I was a trader. I was a young foreign exchange trader, and I watched the system collapse and unfold. I stayed in the foreign exchange world for, I guess, maybe 15 years. I was a broker, went to another bank, and went back to banking in the '80s. I became the New York City Treasury Manager for a regional bank. And then after that, I invented a piece of software, which was a trading system. Spent the 5 or 6 years in the technology world developing that. And then I started my own consulting company and gave seminars throughout that whole time for the industry. And then as a consultant, I did a number of different things. Each project was an experience in and of itself. And I guess after that, spent a little time doing the seminars and kind of stepped out of the business. That covered about 50 years. So Freddie and I are unique in that we've spent a lot of time in a lot of different places throughout the financial industry. In my case, not just a couple of weeks or a few months, but a few years. And I got to know different perspectives, both from the trading, broking, money market, fixed income, bonds, corporate sector, and then as a consultant digging through, I was an expert on maybe 20 cases involving some form of chicanery or another. So our backgrounds are really unusual, but we see everything from different market perspectives.
And I thought about this today. I was talking to Bill, my old friend, as you know well, and he was talking about a radio show that he listens to a lot. And he said that the guy's tagline is, if you listen to me, you'll be a week ahead of the news cycle. And I thought, when we were in trading rooms, we were always a week ahead of the news cycle. We saw things very early on before they happened, and you build it. That's one thing that's been missed about not being in a trading room. As Tim gave you his background, I started at a large French bank, 1979, New York. The branch just opened, and I was able to watch a ticket go through its from the execution all the way into the back office operations, all the way to the payment side 2 days later, spot, and payments made. So it really gave me a good understanding of front office, back office FX. And then moved into a larger bank. I worked for JP Morgan, well, Chase at the time, and a couple of other money center banks. And then I moved to a small Danish bank. And in the small Danish bank, you really got to know a lot of different parts of the business. You learned the interest rate side. The treasury manager who's been on the show, John, has been on this with us before. He was a bond trader. He was a futures trader. He was an interest rate trader. You had the short term. Jim was the short term Fed funds guy and how he funded the bank, and you learn about that. Then moving on to another, back to J.P. Morgan, and learning options and trading interest or forwards. So I ran a forward desk for probably 5 years, 4 years, and in that time, and for those who don't know, forwards in the currency world is the interest differential between two currencies. So at the time it was, the Deutschmark. So you're trading the interest rate differential between those two, or the British pound or the Japanese yen. And there's a lot of natural business that goes through. And you're always focused on the interest rate world because that's what creates the spot world. That's where it all starts and that's where it all ends. So I've, spent my whole career up until the last, I'd say about 15 years, still involved in the markets, still involved in foreign exchange, helping brokers with software solutions throughout the world. Some medium-sized brokers, some smaller brokers, helping them build liquidity profiles, helping them manage risk, helping them grow, but still very in touch with the markets. And that's why Tim and I thought it would be a good idea to put something like this together and talk about what our background has been. We talk on the phone prior to doing this podcast. We would talk on the phone every day about the markets, whether it would be about stocks, about the dollar, about interest rates, about Fed policy, about politics. And Allison suggested, you guys should put together a YouTube channel. It would be interesting. People might find this interesting, the way you guys talk about markets and where your background is. So here we are a few months later, getting into it and growing it. And it's been eye-opening. It's been very interesting watching.
Yeah, little segments of our careers. As you were talking, I was thinking about what it was like when I went back to the bank and I started looking at the treasury side of the world. And once a week, I would fly up to head office and do my work at head office. And I wrote an article, and we would do a radio show once a week airing that article. So I would spend one day a week in Buffalo and 4 days a week in New York City with the traders in the trading room I ran. And I would go up there for an ALCO meeting. Now, most people don't even know what that is, or much less attended an ALCO meeting, but the bank has interest rate risk, and every organization has risks like this. So we had to manage that interest rate risk, and there was not a process for doing so. We had to establish that process. And it was a whole eye-opening world for me to step into a textbook regional bank where people really had no concept of what it was that we looked at. We were just strangers in a strange land. And when we brought some of the people down to find, you would get fed. Imagine managing interest rate risk when people are lying to you about what kind of interest rate risks they're generating. I would go to a meeting.
Are they lying, or they just didn't know?
No, lying.
Okay.
Lying. Okay. We had to figure out, for example, what the balance sheet was going to look like 3 months forward. Now, if we didn't know that, we didn't know what our risk was, and we couldn't manage it. So we would go around to the different departments and get their reports and get their projections and plug them into a model. And we had a guy named Jack O'Mara. And Jack O'Mara was constantly getting wrong information. People would say, well, this is what loans are going to look like, and this is what mortgages are going to look like, and this is what deposits are going to. And it was all bullshit. We didn't get any true stuff. So we formed O'Mara's Law, which means that the quality of information received is inversely proportional to that person's position on the organizational chart. Now, that's a little nugget that might take you 15 years to learn. But what we did was we started drinking with all the people way down under. We didn't go to the top of the department to find out what their projections were because he was going to tell us we're right on plan, oh, everything's fine. So we'd start drinking with the people 4 rungs down from him. And we had the expense accounts because we were senior management and they weren't. And they were really happy to settle up to the bar with us.
Absolutely.
And I'd say, oh, you're right on plan. He'd go, what bullshit? We're nowhere near plan. This is what we're going to look like. And then we would put all those numbers in the model. And then we'd go up to the ALCO meeting and we'd pass around these sheets. And guys would look and say, mortgage pipeline, you got us down for 75 million. I got it for 125 million. And we'd say, well, which number's right? And he'd go, he'd give us some bullshit answer. But gradually, they started to realize that we had a skunk works going, and we knew the information that they weren't telling us, so we could really manage the risk. Now, I'm talking about careers on the line for this, right? You're managing risk that you think you have, and you got positions on to offset that risk and manage that risk, and you're not being fed the right data. How do you learn that? Where's the school that tells you how to do
Right.
that? But that's what my seminars used to do.
Right.
I gave seminars to the industry as a member of the industry associations. I was on the board, the education. I was on the board and also the chairman of the education committee. And then after I left that industry, I started giving the seminars to the auditors in the back office and giving those lessons to people. So that's really hands-on experience that you couldn't have gotten any other way.
Right. Right. It's an interesting perspective. It's a unique perspective to look at where we've come from and how the markets have grown. I tell young people now that are in the markets, you walk into a trading room now and it's silent. All you hear is keyboard clicking and people executing, or not even that. I mean, we've had Steve Flanagan on. He said when he started at J.P. Morgan's e-commerce group, they were doing $50 million a day. When he left, they were doing $200 billion a day. And it was just a matter of tweaking your little price to the left or to the right a touch just to gain more business. And they grew it. But back in the day, it was a noisy scream session, you know. We had Paul Heffernan on, and Paul was my broker down on the floor. We did a lot of CME arbitrage, and it was unique because you felt the pressure, you felt the intensity, you knew when things were moving, the energy. People talk about the energy in the room. You knew when the energy was building up and something was breaking out. And as I grew and got into the interbank market, and when you would call, we had a direct dealing market where you would pick up the phone and call your counterpart in Zurich, in Basel, in London, in all over. In Paris, this is Fred from Chase, New York. What's dollar mark in 10? And you couldn't show fear. You were trying to get out of a bad position. You couldn't show fear, right? You just had to suck it up. And being down on the floor, they looked in your eyes and you couldn't hide. On the
That's
phone,
true.
at least you could hide.
Yeah. When I went to the bank, it was a small little regional bank that wanted to step into the world. And the first thing we had to address was our access to interbank and international funds. And we were just a small little regional Buffalo bank. But we had a lot of capital for our size. Our capital to assets ratio was far greater than our peers. But we had to communicate that somehow to the industry. And who was going to be bothered to look? So what I would do was I would have my traders, and I would do it myself, make markets in rollover. Now, rollover is the way that you finance a position. You don't spend a lot of time looking at it because it's not a market movement. It's just funds that have to be
Funding tool.
taken care of. You have marks and you got to turn and convert them into dollars for a day because you're dollar based. So you would do these things. So nobody ever made markets in rollover, bids and asks, but we did. And the reason I did was because I would gum up the works for everybody else. Somebody would say, "Oh, I need rollover. I need marks today against tomorrow, or I need sterling today against tomorrow because I'm short." And a broker would say, "Well, I got some. It's M&T Bank." And the trader would say, "Well, I don't have a line to him. I don't have a limit to him." Well, after a week of that, he'd say, you know what, maybe I better go get a line to this guy. And he'd send a note to his credit people, and they would look at M&T Bank and say, you know what, they got good capital to assets. We should have a line to them. And all of a sudden, we went from like having no facilities at all, the ability to borrow Fed funds, for example, maybe it'd be $100 million. And it went from 100 million to like $500 million because everybody started to know us. And I used the markets for that.
And there was
And
no risk in that. In rollover, you weren't going
no,
to make
not at
or
all.
lose any money. No, it
No.
was just, yeah.
I mean, somebody who didn't know would say, okay, let's go hire a public relations firm for X million dollars and get our name out there. And what I did was I let the markets do it for us cheaply, efficiently.
Smart, smart. But yeah, I'll go back again. We've had a unique background in watching different administrations come into the market and out of the market, different crises develop. I remember being in the trading room when long-term capital went under, when Drexel went under. We had to revalue Drexel's books. They had big options positions, and JP Morgan wound up heavily involved at the time. And
The 87 crash.
the 87 crash. Yeah. Oh, yeah. There were so many fear moments that you had. We joked about it the other day. We had a Swiss franc trader who was very in tune with the IMM, with the CME, the Chicago Mercantile Markets, the futures markets. And I don't want to say he would start a rumor, but this was during when the Russians were threatening Poland and they were going to go into Poland, and the fear was that the Russians were going to move and there was going to be war. And he would pick up the phone to his broker. Hey, I just heard that the Russians just ordered 4,000 rooms at the Warsaw Hilton just to start. Just
Let people start talking about whether or not it was doable.
right. It was this comical way of starting things up.
But we looked at markets as messages. Like, I mean, I spent a couple of years as a Eurodollar broker. And you'd see, the market might be 5 and 7/8 to 6 for prime names. But you get smaller names paying like 6 and an eighth, an extra eighth of a percent because they couldn't get the money and had to pay up for the money. And then when you saw a prime name have difficulty getting money at where he's supposed to get money, you know that bank was in trouble. The credit markets knew it before anybody else knew it. So we would see that right before our very eyes. You'd scratch your head and say, how come this name can't do it? And then all of a sudden you'd find out they got big exposure to Latin America and Brazil just defaulted or something like that. But the markets knew it before everybody else knew it.
I remember one time being at the desk, big money center bank, and everything was focused on the Fed fund rate. Dollar mark would move 30 pips when Fed funds went up 0.25%, 50 pips, right? It was everything. Everybody followed page 5 on Telerate. The upper left-hand corner was the Fed fund indicator. So the treasurer at the bank came over and said, what do you guys think? I think the market's a little short. We might have a little run up. If we'd start to see a little tick up in Fed funds, I think that would work. Okay, I'll be right back. He says, go buy me $50. Okay. So at the time, you're talking early 1980s, $50 million was a sizable position. He'd walk over to the Fed fund desk. He'd buy 2 billion Fed funds. Once again, the risk is not huge, but all of a sudden, dollar mark is up 50 pips. It's running. All right, get out of my dollar mark. Walk back over, sell his Fed funds, and walk away.
Today we call that manipulation.
Exactly. But 40 years ago, it was a way to play the market. There was another guy that worked in our London office when I worked at a Swiss bank. He was a very senior guy, very bright, very bright. You remember him too. I'm trying to think of his name. He had one line.
I think I know you mean.
Yeah, bright guy, really bright guy. But he felt he had to make $20,000 a day trading before he got into any meetings. He couldn't speak to anyone. He had to sit at the desk and make his $20,000 a day trading before he could move on. He had to prove his worth. Yeah. Interesting.
And when you had so many characters, the interesting thing was, I mean, you worked at a money center bank. You had branches all over the place. I didn't. I worked at a regional bank. I didn't have branches anywhere. So I had to have friends look out for me. So if something was going on at 3 o'clock in the morning in our time in Germany, I'd get a phone call from one of my friends saying this is happening. And I get up and I go to work because my heart's not going to stop beating. I'm not going to go back to sleep. So whenever I had a chance, whenever I saw this guy, it was party for 2 days, 3 days in a row. He could not take his hand out of his pocket in a bar for anything. And I made it a point of doing that. And I would go to all these conferences just to see these people, to make friends, because I didn't have branches. Nobody's going to call me up from London and say, well, I got my branch in New York. No, I got a couple of friends I better call. I better call Tim and tell him what's going on.
Right.
So you really had to have relationships. And every city was the same. It was a bar.
Yeah.
It was a bar in the financial district, and that's really all it was. So you got a hotel near that bar.
Yeah. It was, your word was your bond, and it meant a lot. And your face, you only had your name. And if you screwed somebody once, that was it. You weren't going back. So it
That's
really
true.
was.
That's true. You'd get a call 3 o'clock in the morning, do a trade, know that when you went in the next morning, there'd be a ticket on your desk and the
Yeah.
thing was done.
It's real. It's all verified and accounted for. It was a great community, and the machines did. I don't want to say destroyed it, but certainly we lost a lot of those personalities. Will you talk about a guy that you worked with that was my broker for a while, Jorge? Jorge went down to Australia, and one Sunday afternoon, I'm talking to the guys in Sydney. It's Sunday at 3 o'clock New York time. Sydney's just opening up. We're talking about where the markets are, and this is the time where voice brokers would scream prices up and down the line. And I'm talking to the guy at, I guess it was CBA Sydney, and I hear, 50 bid dollar mark. I said, is that George Marrero? Is that Jorge? You know Jorge? He's my best mate. I was like, wait a minute, he's my best mate. We're on the other side of the world. He's my best mate. And it just translated, and that those personalities, they stick with you.
How about when you got a call from Jorge at 8 o'clock in the morning when you were in work?
Oh
Tell
yeah,
that story.
yeah. I was a kid still in high school, working in work doing billing at your office, and I would come in the morning sometimes on a day off and do some work. And the phone rings, and everybody's busy. And I guess I pick up the phone. I pick it up, Maladorni. Hello, where am I? And I knew exactly who it was. As a George, I can tell you where I am. I really can't tell you where you are. He says, it looks like a Holiday Inn. Tell him I'll be in at 10 o'clock. Click. Yeah. Yeah.
Yeah, they were characters. Everybody was a bigger than life character. It was like a theme park
Yeah.
with people. So many.
Yeah.
And when it was busy, you were crazed busy. And when it stopped, you didn't know what to do with your energy. You're still pumping up, your leg was
Yeah.
shaking, you're pouring down a cup of coffee. And the quiet times were dangerous,
Oh,
really
yeah.
dangerous.
Yeah. I mean, we talk about all the markets. I mentioned options when I was on the options desk. We used to have this. We had a trading room that had to be 120, 150 people, right? And we had this huge ceramic candy bowl, huge bowl. And every now and then somebody would go out and they would pour um, M&Ms into this bowl, and you'd hear them clank, ding, 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 ding. So one day somebody said, "Geez, I wonder how many M's. I wonder how many ounces of M&Ms this dealing room can eat between 10 a.m. and 3 p.m." Well, make your market. I know we had a snow market, we had a Stanley Cup market, so this
Right,
was
a
M&M,
mouse market.
the mouse market. And we talked about that here. This was M&Ms, and you would hear that clink, and everybody would turn around, and people would run up and grab their handful and handful. Um, so we made a market. The young kids were amazed. Dollar an ounce. How many ounces? So 16 ounces to a pound. How many pounds can we eat? There's 120 people. We're talking about 4, 5, 6 hours. Trying to calculate and figure out what that number is. And the market started, and people would buy and sell and buy and sell. And I was on the options desk at the time, and I said, "What are the 120 calls?" What do you mean? 120-ounce calls. What's it worth? The market's trading at 95. What is it worth? Is it a buck? I can buy it for a buck. $2. All right. Yeah, give me two of them. Give me two of them. All right, yeah, you're done. You're in. And then you start to see it. And the way they calculated it is the guy who was controlling the candy desk. He would have 5 pound bags, he would have 1 pound bags, he would have little, so you never knew how much was really going in. You just heard the clink and you ran over. And he had them all under his desk, all locked inside, and then we totaled them all up later. But kids learned how to trade options.
When we had to teach people about markets, now these were like auditors and operations people, really have no concept. So we had to explain. We had a 3 day seminar, and we had like 2 hours to teach them what a market was. So we would say, okay, maybe there's 30 people in the room. Write down your age on a piece of paper, not your name, just your age, and pass it over. And then we would add up then, and then we would start a market on the average age of the people in the room. And they'd all look at each other and start to calculate. And then, the market would start off here and drop here, and then it would settle at some number. And some of them, 34.6 is pretty much the price. And then Ken would say, now what if I told you that he fought in the Korean War? And all of a sudden you see 35 bid, 36 paid.
That's right. Yeah, those are interesting times working it all through.
But having said that, we sort of look at things, and if you know anything about markets, a market doesn't deal in reality. It deals in what people think the reality is. So you're trying to figure out how this particular news event is going to go over in the crowd, not for the end result. You see something, an oil field blows up, a big oil field, and I'm just making something up here, and all of a sudden oil is going to be scarce, so it's bullish for oil. Well, you'd say, all right, is the crowd going to pay attention to that? And that's the issue. What does the market focus on, and when does it decide to focus on it? Because if you're out of step with that, you go broke waiting.
Right.
They're not looking at something that you consider very important, then you're out of luck. You better get in step and find out what they're thinking. And those are the most important words for me when I was in a trading desk. I would make a phone call, talk to somebody and say, what do you think? And he'd start to tell me why he's thinking what he's thinking. And I would know that, at least as far as he's concerned, his market focus is here. Now let me establish that with 5 more phone calls and find out what they're focusing on. Because, look, we got a $36 trillion debt. It's easy to focus on that. But if the market's not paying attention to it, you can focus on it for 3-4 years and wait until they do. So you got to determine what the event is of the moment.
I always talk about timing when I do the seminars that I've done for people, and I said, it used to be a big thing about the aging population in Japan. It's growing, and Japan's going to run out of people, so we got to be short yen. Well, that's a good thesis and a good theory, and you may want to build a position around that, but you can't put a 1% stop loss on that trade because it's going to take 3 years, 4 years to develop. So you have to have your sights set with your ideas.
I'll give you a good example right now. I believe that Trump is going to drill, baby, drill. And I believe, and I've said this on our podcast, I believe that natural gas and oil will be lower a year from now than where they are now. But just yesterday, somebody went to Europe and did a deal, and now we're going to export a ton of natural gas to Europe. So natural gas is up 2%. There's short-term demand for natural gas. It's biting that position in the ass. So you got to manage your time frames.
Absolutely. You got to figure out what type of trader you are. If you're in this market, are you an investor? Are you a short-term trader? Are you a medium-term trader? I remember one time, given my as a junior, given my thought process to one of the senior guys on the desk.
Frank Christie at Chase.
No, it was actually Jim at Manhattan. And he said to me, I think you're right. He said, but you're going to have to wait through 2 or 3 non-farm payroll numbers to justify itself. He says, are you willing to hold this position for 3 months? He says, because that's what it's going to take. And you draw those squiggly lines, the straight line, the first one, and then the big line, the up and down. What type of trader you are? Are you going to go in and out for 3 pips, 5 pips, 7 pips? You're going to go in and out for 1%, or you're going to go, you buy it in January and sell it in June. You got to figure out who you are inside. And you only do that to yourself. I can't tell you who you are. I can't tell you what your risk tolerance is.
Yeah. Well, in a bank or when you're working for somebody, they tell you what your risk tolerance is. Your
Yeah,
limits
but you
do
could
that.
you could judge your size. You could judge your size if you're a long-term risk guy. If you're looking for long-term strategies, well, you want a small position. You're not going to load the boat.
But within your
Yeah,
limits set those parameters. So you're
yeah,
within. I remember I went to Cleveland and I got interviewed for a job. And the guy who ran the room really was a sales guy, not a market guy.
right.
And I remember he said to me, "Well, what's your philosophy?" And I said, "Well, by and large, these markets are efficiently priced. And you wait, and a few times a year, they get inefficient. And if you can identify those times, that's when you load the boat on your position. Other times, you're in it to identify those times." And I could see his eyes glaze over, and he had no idea what I was talking about. And I said, this is the wrong place for me. This guy really has no idea.
Yeah, it's so true. There's people that want you to trade every day, and you always maintain that there's three positions: long, short, and square.
You made 10 winning trades and 2 losing trades. Why'd you do the losers?
Right. That's right.
I love that one.
The duty analysis. Yeah. Well, as I said, this is how we look at markets, whether from the political side, from the trading side, whether it be equities, interest rates, stocks, currencies. That's our background, and I just wanted to spend this session, this little 30 minutes or so, just talking about where we come from. And
And I think it's fair to say that a lot of our conversations have to do with trying to figure out focus,
yeah,
where the markets are looking and what's important to the markets this week. Not so much what's really important, but what the market thinks is important.
yeah, 2 months ago, when Trump was first elected, we talked about the analogy of the Trump's a builder and he's going to build a house and it's going to look great on paper and the whole breakdown is going to look great. But at some point, he's going to have to replace the windows and replace the heating system, and there's going to be a lot of problems. Well, I think that's what we're going through now, right? This whole idea that, wait a minute, he's going to fire 3,200, people in this department, and he's going to close down that department. We can't have that. But that's the focus now, and we were a month and a half, 2 months ahead of that.
Yeah, let me go into that for a minute. I think these markets are coming to grips. There's really two major drivers of the markets we look at. One is monetary policy, and the other is fiscal policy. And our markets are conditioned to look at monetary policy. But at this particular time, that's the wrong focus because there are enormous changes ongoing now, literally inside of a day, changing fiscal policy. We could hear that the tax code has been presented and has a lot of support for a flat tax or something like that. Or giant departments are being rearranged and retrenched and recircused, and a big amount of money is going to in this direction rather than that direction. So fiscal policy has become much more important than monetary policy. And the Fed has been relegated to a place where they're really a lot less important than they were a few months ago. Now, I'm not saying monetary policy is ignored, but it's certainly moving to the back of the line, and fiscal policy is driving these markets. Now, it's a very confusing time to figure out what fiscal policy is going to look like, and it changes, and that's the kind of things we look at day to day.
Yeah. Yeah, well said. Once again, if you enjoy hearing us ramble on, please subscribe, ring the bell, give us your comments, let us know what you think, and we'll be back next week.
Okay,
Thanks, Tim. Have a great weekend.
you too. Take care.
All right.